Hey Bowtie Nation, Joseph Hogue here with the big picture for you, because the big picture is where the money is made. Yeah, you could have made 51% over the last year investing in the Magnificent 7 stocks, those mega cap tech darlings, but it meant picking the best 7 stocks out of a market of 7,000, having all your money in them, and hoping like hell you weren't wrong. But invest in the bigger picture, the broad group that includes those Magnificent 7 names, and you still would have made a very strong 32%. While spreading your risk across more than 100 stocks. But it's not just about making the highest return either. Understanding the big picture investments and how they work together will do some amazing things for your money. That's why I'm ranking the 10 major investment categories by return. Stick around and I'll reveal how to use them together in a portfolio and how much to have in each. First up is cash, and I know you probably don't think of that crumpled green stuff in your wallet as an investment, but it is an important part of your portfolio. Here I'm not just talking about those paper bills, but also money market funds and short-term treasury bonds with less than a year to maturity. Cash is like your dependable friend who never lets you down. It's there when you need it and doesn't throw temper tantrums when the market gets a little moody. It gives you that flexibility, ready to be deployed for emergencies or opportunities like snatching up stocks on sale. Plus, cash won't suddenly decide it's worth 20% less overnight, unlike some other friends. Of course, the kicker is cash is about as exciting as watching paint dry. Sure, it's safe, but in a world of investing, safe comes at a price. Inflation is like that sneaky roommate who keeps eating your food. Even if you don't notice it right away, over time, inflation quietly cleans out the fridge and purchasing power of your cash. So while your cash just sits there being all responsible, everything around it is getting more expensive. Thanks a lot, inflation. So then, of course, the biggest drawback to cash is that return. In fact, barely a positive return when accounting for inflation. I'll be using the novel investor asset class returns chart here, which shows real returns for each year over the last 15. Hover over each asset class, and you see each year's returns, even if it's a little hard to see, but you can see even in the worst years for other assets like stocks and bonds, even then cash is usually at the bottom of the chart. Looking at the longer-term average, we see cash represented by short-term T-bills has produced a 0.85% annual return over the period. So then why even hold any cash? Well, because even though it's not glamorous, it is necessary. Cash provides that stability in your portfolio, allowing you to take advantage of the opportunities as they come along. Think of it as the foundation for your financial house. Maybe not the flashiest part, but without it, everything else can crumble. Having cash on hand means you don't have to sell other investments in a panic when you need that quick money, which is a big win in my book. We won't hold much cash in our model portfolios that I'll show you later, but we will want to hold some to save your financial future. We'll call this next asset investment grade bonds because talking about loans to the government and big companies would put half of you to sleep. IG bonds are the respectable members of the bond family, loans to only the most financially healthy companies. Of the 10 levels of bond ratings by risk, only those with the 4 highest ratings from BBB to AAA are investment grade. And to give you an idea of how hard it is to get that, not even the US government has a AAA rating anymore. And stability is the name of the game here with IG bonds, the responsible adult in the room. While your stocks might be out partying and getting all volatile, your bonds are at home reading a book and getting a good night's sleep. They provide a steady stream of income, usually through semi-annual interest payments, which is nice if you like the idea of money just showing up in your account every 6 months. Another perk, bonds tend to be less volatile than stocks. So while stocks are riding that roller coaster, bonds are on the merry-go-round. Sure, it's slower and a bit more predictable, but at least you're not screaming your head off. And during those market crashes, bonds can act like a buffer, helping to smooth out the ride. But before you go all in on bonds, let's talk about the downsides. And the big one, of course, is low returns. Sure, bonds are safe and stable, but they're not going to make you rich. Think of them as the tortoise in the race if the tortoise didn't win but was satisfied with third place. Looking at the returns on investment-grade bonds, and it's better than cash, but not much, still showing up in the bottom half of the chart for most years. Importantly, though, you do see that these bonds do well in the worst years for stocks, like in 2011, 2018, and 2022. Over the long term, bonds of highly rated companies have produced a 2.6% real return, and remember, that's after inflation, so that return is 2.6% on average above inflation. Now, another downside to bonds is that interest rate risk. If interest rates go up, the value of your existing bonds goes down. Investors in new bonds are getting higher rates, so why would they want yours at lower rates? It's like trying to sell your old iPhone after the new one just came out. Suddenly, it's not quite as valuable. So then holding high-quality bonds in your portfolio is a lot like cash, but with a return kicker. They provide balance, reducing overall risk, and adding that layer of predictability to your returns. In a well-rounded portfolio, high-quality bonds are like the ballast in the ship that keeping you steady when the seas get rough. They might not be the most exciting part of your investment strategy, but they are essential for anyone looking to avoid those gut-wrenching swings that come with an all-stock portfolio, along with the opportunity to sell some bonds and buy in during a market crash. Again, like cash, it's not going to be a big part of your portfolio, but a critical one. We're talking big picture investing today, but that doesn't mean you don't need any individual stocks. If you want to see the 5 stocks I'm buying for the next 30 years, my forever stocks, these are the stocks I'm following in major multi-year themes, with one of the picks up 100% and the group up an average 94% last year alone. That report is totally free. You're going to see the first stock immediately, and they'll email you with the full report and the other stocks. It's an easy way to support the Let's Talk Money community and see some of my favorite stocks to buy, so look for that link below. We won't spend a lot of time here on emerging market stocks, and this might be the only asset class you can totally ignore. These are stocks from companies where the economy is still trying to decide if it's going to be the next big thing or just another chapter in an economics textbook about what could have been. These are stocks from countries like Brazil, India, Colombia, and South Africa, places where the economy is growing faster than your average developed market, but things like standard of living, productivity, and overall output just haven't caught up to the developed markets yet. The idea is that because they've got so much further to catch up and they benefit from those tech developments worldwide, their economies and the stocks will continue to grow faster. Investing in these stocks can be kind of like betting on the underdog team. The upside can be huge if they pull off the win, but ask any Vegas odds maker and they'll tell you there's a reason why they're long shot odds. So the upside is years like 2009, when EM stocks returned 79% or 37% in 2017. Unfortunately, the downside and the reality outweigh the pros on this one. Nation, understand this is coming from someone that specialized in emerging market analysis for years. Hell, I was a panel expert at a Bloomberg EM conference in 2011 and lived in Colombia for over 10 years. I drank the Kool-Aid. But Nation, after following emerging market stocks for more than 25 years and as a professional analyst, there is a reason why these markets are always emerging. From a lack of trust in institutions, corruption, a weak rule of law, to cronyism in government and business, and just runaway inflation, for every one step forward these economies make, they eventually end up taking 2 or 3 backwards. That's why for all the upside promise of emerging market stocks, the ultimate returns are more than a little disappointing. There is considerable risk here, as you see in some of these down years. The risk that the emerging market leaders go batshit crazy, as they so often do, and destroy those stock markets, sending returns to the lowest among assets. While this year's returns have been good, EM stocks have spent half the 15-year period at the bottom of the chart. Looking at the long-term average, we see a return of just 6.9%. Which may seem okay, but considering the higher risk you have to take, it is just not worth it. It's for this reason that I am leaving out emerging market stocks out of our sample portfolio at the end of this video. I wanted to cover the asset class because it is an asset class, and because I do think you can add them selectively if you analyze a specific country or company and buy those. While the overall emerging market index doesn't produce the kind of returns we want for that level of risk, you can do well with smaller pieces of the group. Back to the must-haves in your portfolio, and stocks of companies in developed markets. These are the stocks from the more mature economies outside the United States, like Europe, Japan, Canada, and Australia. Basically the countries that have been around the block a few times and have the wrinkles to prove it. When it comes to foreign stocks, these are like the finely aged wines. Maybe not as thrilling as a tequila shot, but it won't leave you with a headache in the morning. The upside to international stocks is the lower risk you get when adding them to a portfolio of US stocks. Yeah, the returns aren't as high as we'll see in the data, but spreading your risk out to the other countries' stocks has its benefits. When the US is having a bad hair day, maybe the European markets are looking pretty sharp. And if you don't think that analogy is apt, while the US was working through whatever this is in the 80s, and the S&P only did about 12% a year, Europeans were rocking the punk look and a stock market pushing 16% a year. And if you're thinking the US national debt at $35 trillion is getting a wee bit out of control, then those foreign stocks are going to give you some currency safety as well. If the dollar does crash under the weight of that debt, shares of foreign companies will actually increase because their assets are in those foreign currencies. For the lower risk in developed country stocks compared to those emerging markets, you'd think you'd have to accept a lower return, but it's not the case. While foreign stocks also end up at the bottom of the chart in quite a few years, they have enough strong up years to produce a solid overall return. That long-term return works out to 7.4% over the 15-year period. It's not as high as some of the groups of US stocks, but it's a healthy return, and there are reasons to add it to your portfolio. We're coming up on the 5 best investment groups by return, but I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. High-yield bonds are like the bad boys of the bond world, the investments your boring parents told you not to buy. They're riskier and unpredictable compared to those high-grade bonds, but the returns are irresistible. High-yield bonds are bonds issued by companies that aren't exactly the top of the class when it comes to credit ratings. If we're looking back at those ratings, these are the bottom 6 tiers, all the way from, oh, that's not so bad, to, oh shit, where did my money go? But for that risk, you get a much higher return. In fact, more than 3 times higher than those high-grade bonds. High-yield bonds still pay out interest twice a year, and even though they're riskier than investment-grade bonds, they're still safer than many of the stock groups we'll talk about. That means they'll lower the ups and downs in your portfolio without making you give up a lot of the returns. When stocks are having a meltdown, high-yield bonds might be holding up pretty well, giving you a bit of safety net, or at least a cushion to soften the blow. But don't get too carried away with these either. There is a reason high-yield bonds are also called junk bonds. The companies issuing them are more likely to default, which means you could end up with nothing but a sad story if things go south. They aren't the long shot nag at the races, but you shouldn't be too surprised if it throws the jockey and then eats him. And normally, you would expect something with the word bond in it to be super safe and with the lower return that goes with a little less risk, but high-yield bonds trade much closer to stocks in terms of risk and returns. They don't finish at the top of the chart much, but also don't show up on the bottom either. Overall, it's a solid 9.1% annualized return over the last 15 years, which is more than either EM stocks or those of developed countries outside the US. That, along with some safety in down years, should put these high-yield bonds on everyone's radar. Dividend stocks aren't a defined asset class, but I wanted to include them here because, well, who doesn't love collecting that cash flow? I mean, dividend stocks are like that friend who always insists on picking up the check at dinner, or my favorite, using my dividends from Coca-Cola shares to buy a Pepsi. Dividend stocks are typically mature companies with stable cash flows in industries that maybe aren't growing as fast as they used to. As a result, they can afford to pay out some of their earnings to investors rather than reinvest those earnings back into the business for growth. And for a lot of investors, that steady income stream is all the argument they need. Even if you're not living off your dividends, just seeing that check hit your account is all the motivation you need to keep investing. Another big upside is dividend stocks tend to be less volatile than those non-dividend paying stocks. These are companies in solid industries with consistent earnings, so while the market might be throwing tantrums, your dividend stocks are likely cruising along, paying out those dividends like clockwork. Now, of course, the catch to all of this is because they are in slower growing industries, or the simple fact that paying out earnings as dividends leaves less to invest back into the business, the stock price on your dividend stocks isn't likely to shoot higher like your tech stocks. It's like being on the B squad in the football team. You're good, but you're not getting any cheerleaders. Again, dividend stocks aren't a major asset class, so they're not going to be on our long-term chart, but we can use the Schwab Dividend Fund around since 2011 or other ETFs to give us an idea of those long-term returns, using historical data back to the fund's inception, and using this adjusted close column, which adjusts the fund's price by any dividends or stock splits. We can find the total return over that period, so a return on the investment including stock price and dividends. Dividing the current stock price by this adjusted close number, we see that over the 13 years, the dividend fund has produced a total return of 372%. Now, using this exponent function or the little hat key, we can see that comes out to almost 12.7% a year over that period. Minus out annual inflation around 2.4% over that period, and that puts us solidly in the top 5 for investments. That is a solid return, but if we're just going for upside, why hold dividend stocks at all instead of one of the next 4 asset classes? The answer is because they offer that sweet combination of income and return. They provide the steady cash flow, the motivation seeing that dividend come in, while also taking some of the risk out of your portfolio. All you out there in the nation know I got my start as a commercial property analyst and managed my own rental properties. Real estate will always hold a special place for me, but after 5 years of leaky faucets and the post office clearly losing the rent checks after tenants mailed them, I've put most of my property investment into real estate stocks. These real estate investment trusts, or REITs, are shares of companies that own and operate income-producing properties. It's a special business structure because if they pass through almost all their profits to investors, the companies pay no income taxes, so it's a very efficient way to hold property, and you get a higher dividend than most stocks. Just like those dividend stocks, the upside here is that regular cash flow. Unlike dividend stocks, though, REITs can still post some solid returns on top of an income yield that's higher than the market average. Real estate stocks also add a different flavor to your portfolio. They don't always move in tandem with the stock market, so when your other stocks are tanking, your REITs might be holding their ground or even doing well. There are some downsides, though, that can hit those returns and the cash flow specific to real estate. As we've all seen over the last few years, when interest rates go up fast, the real estate market is the hardest hit. That means lower stock prices and sometimes even lower dividends. We're back to the major asset classes with real estate stocks and some great investments, but you also have to be ready to sit through those bad years. This chart doesn't show the housing crash of 2007 and 2008, but if it did, it would look a lot like the last few years with real estate stocks at the bottom of the chart. But like a rubber band that builds up its tension, real estate has a tendency to snap back with some very strong returns after years of a sell-off. And that's why I think the next few years could be very good for real estate. Investors have been rewarded for that patience with a 10.8% annualized real return over the investment over that long term. That's enough to put real estate at the top 5 in our asset classes and in your portfolio. Small cap stocks are the asset class you don't hear about much, but definitely should. These are the scrappy underdogs of the stock market, the little engines that could, or at least trying really hard. Small cap stocks are shares of companies with a market capitalization, so a total value of their shares between roughly $300 million and $2 billion. And while $2 billion may seem like a lot, it's nothing in stock market terms. I mean, Nvidia is 1,500 times larger, but these smaller companies have potential. They're like the freshmen at high school, full of potential, but still kind of figuring things out. And that potential is upside returns. We're going to see in the chart, small caps were the top performing asset class in 3 of the last 15 years and posted returns above 20% in 6 years. Small caps have that room to keep growing too. Even a return of 10 times your money would barely put these in the 500 largest companies in the United States. Try getting that 10x return on shares of Nvidia, and it would have to grow larger than the entire US economy. But on the downside, if you're the kind of person that gets nervous about your stocks, small cap stocks might give you some extra wrinkles or keep you up at night. These are smaller companies with less financial flexibility and fewer size advantages than those giants like Amazon, Google, and Apple's out there. That's going to mean more risk and more ups and downs in the price. That said, small cap stocks could be one of the best kept secrets in the market for returns. They have tough years, but when times are good, these produce some very respectable returns of 20% and higher. Over the long term, small cap stocks have produced an 11.3% annualized return, the second best among the major asset classes, and third best when considering a few other groups I'll highlight. On the other side of the market, you have those large cap stocks because sometimes bigger really is better. Large cap stocks are the giants of the stock market, the big players with market caps over $10 billion. Here we're talking about the Apples, Microsofts, and Amazons of the world. These are the companies that dominate their industries, have global reach, probably have more cash on hand than some small countries. And as a result, there's less risk in these large caps versus the smaller companies. These companies have been around the block, weathered economic storms, and come out on top. It's like betting on a horse that's already won a few races. You know they've got what it takes to go the distance. Now, the downside to investing in large caps is sometimes the companies and management can get a little too comfortable. They don't see those fast, adaptable, smaller companies taking market share until it's too late, and the fall is spectacular. When I was a professional analyst, we all carried BlackBerry devices, and Research in Motion was the company in the industry. Then Apple and Google ate its lunch, pushed it in the mud, and rubbed its face in it. Intel is another example. This was the chip maker for years, but now might actually make more money if it were selling potato chips. Large cap stocks are the big dogs of the market and offer some big returns. You see, they generally place in the top half of returns. That's not to say that there aren't bad years, but they're fewer, and those up years more than make up for it, with the annualized return of nearly 14% after inflation. It's the best among major asset classes, and only one group in our rankings does better, and that's tech stocks, the rock stars of the stock market right now. Whether it's the latest iPhone, AI advancements, or some new app that you didn't know you needed until yesterday, tech companies are always at the forefront of innovation, and who wouldn't want a piece of the companies basically running the world right now? If regular stocks are like the slow and steady tortoise, tech stocks are the rabbit tweaking out on meth that could finish in half the time. The Vanguard Total World Stock ETF, ticker VT, has produced a 60% total return over the last 5 years. Our tech stock ETF, the QQQ, has almost tripled that, rising by 164% in the same period. And pick the right tech stock like Nvidia, the race isn't even close. Because those returns are so good though, investors rush into these stocks, bidding the prices up to the moon. When everyone's piling into the same stocks, prices can skyrocket beyond what the company's actually worth, and one bad earnings report or news can send the stock plunging. Like dividend stocks, tech stocks aren't a defined major asset class, so we're going to use the QQQ Trust. It's an ETF that holds shares of the 100 largest companies traded on the tech-heavy NASDAQ exchange as a proxy. This fund goes all the way back to 1999, giving us lots of data, but we'll use 2009 to give us that 15 years and comparable to our other asset class returns. Again, we'll be using this adjusted close column to show us the stock price adjusted for dividends, then taking the current price divided by that 15 years ago, we see that tech stocks have multiplied our money by 12-fold. That is a 1,200% return. On an annualized basis, that works out to 18.7% with inflation, so adjusting for inflation still leaves us with 16.3% annualized real return, easily putting tech stocks on top of the other asset classes or investment categories. I'll reveal how to put all these into a portfolio and exactly how much to have in each next, but one thing these investments lack is serious cash flow. Even the dividend stocks only pay about 3% from the funds. Check out this video next then for 4-stock portfolio that puts cash in your pocket every single week. Double-digit dividends to pay the bills whenever you need money. I've ranked all 10 investments by long-term returns, along with a simple fund that gives you exposure, but before you rush out to buy only that tech stock ETF, there are reasons to use nearly all of these in your portfolio. I'm going to explain why and show you about how much of your portfolio to have in each one as you get older. Now, understand, of course, that this is only a suggestion, a kind of a rough estimate for how much, and your portfolio is going to depend on your needs. Putting all these together only lowers your total return a little, while giving you the flexibility to invest more when stocks fall, as well as not seeing your portfolio crash along with the market. That cash and bond portion is going to give you the ammunition to invest and protect your money. Foreign stocks, real estate, and high-yield bonds offer a little higher returns, but still some safety and diversification from stocks. Here in your 20s and 30s, you've still got so much time to invest that you really don't need much safety or protection. Even if stocks do crash, you've got decades to let them rebound. Bear markets may come every few years, but they generally last less than 12 months, so you can just wait it out. You've got about 10% in cash and high-grade bonds to use if stocks do crash, but still most of your money in stocks. These percentages and the long-term average returns are still going to give you an average portfolio return around 12%, but also some sleep-at-night safety. The portfolio weights in your 40s and 50s are going to look very similar because most people still have more than a decade left to invest. That's long enough that even if a stock crash does hit, you've got time to see those prices rebound. You might switch some of your stock exposure to those high-yield bonds for diversification, but you're still very much in stocks. As you do get closer to your mid-50s or closer to needing that money for expenses like tuition, you're going to want to start adjusting your portfolio closer to the 60s weights to protect what you've built. Then into your 60s or within 5 years to retirement, you really want to start thinking about protecting what you've got. Nation, I've seen too many investors push their portfolio with all stocks all the way up to when they want to retire, and too often, for example in 2000 and 2008, a market crash totally wipes them out. For that safety, you want to increase your exposure to high-quality bonds and safer dividend stocks as well as those foreign stocks that, while they may not be big return drivers, they can protect you from a U.S.-specific problem. You still have lots of growth with 30% of your money in stock indexes and a solid 10% average portfolio return with these long-term numbers. You still need some money in stocks, even in retirement, to help keep growing your portfolio as you spend it down. So here we have about 40% in stocks, not including real estate. We've increased the cash component, and you might want to hold even more than that for emergencies, but you've got more in high-quality bonds as well. Overall, it is definitely a safer cash-flowing portfolio that is still going to provide some return while protecting your money. Get your free report and see the stocks I'm buying for the next 30 years, my forever stocks, with the link in the description below. Or click on the video to the right for a simple 4-stock portfolio that will put cash in your pocket every single week. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.